The stock market has been on an unprecedented run of success over the past few years, with the Dow Jones Industrial Average hitting record highs and the S&P 500 increasing its performance yearly. However, this impressive performance has led many analysts to warn that the market is in the biggest bubble in history. The first signs of a bubble in the stock market date back to the introduction of quantitative easing policies in 2008. Central banks implemented these policies as a response to the financial crisis of 2008, which caused a significant decline in global equity markets. The policies aimed to encourage economic growth by injecting large amounts of money into the financial system. The Fed has expanded its balance sheet by more than $4 trillion since the advent of quantitative easing. This expansion helped inflate stock prices because it made borrowing cheaper for companies, encouraging them to take advantage of low interest rates to buy back their own shares or invest in their businesses, which increased their earnings and ultimately drove up stock prices. Additionally, the low interest rate environment created by quantitative easing also encouraged investors to seek yields in riskier investments, such as stocks, rather than settling for lower returns from traditional bonds. The central banks have continued to use these policies even after the financial crisis subsided, leading to a prolonged low-interest rate period that incentivizes borrowing and investing. Stock prices have been buoyed by this low-interest rate environment, which has provided companies with easy access to cheap capital, enabled them to restructure their balance sheets, and issued generous dividends. Moreover, the current bull run in the stock market has been fueled by a rise in passive investing, which the low-interest rate environment has also aided. Passive investing, which involves purchasing exchange-traded funds, ETFs, that track broad market indices such as the S&P 500 or NASDAQ, has grown in popularity in recent years because of its low fees, transparency, and simplicity. ETFs also benefit from share buybacks by the companies they hold. So as those companies buy their shares back and raise earnings, the ETFs grow larger, which attracts more investors and boosting stocks even further. The cycle continues.